everyone. Mike Halla here from Michael E. Halla and Associates, and I'm happy to welcome you to our August 2023 update. Today we have an update on the markets that might affect your financial outlook. So let's dive right in. What's going on with the markets and the economy? Long-term Treasury yields are up substantially since last fall, while the stock market, after a big rally, has stumbled so far this month. Meanwhile, the real economy appears to continue to chug along, even accelerating, while inflation has dropped a great deal versus a year ago, but will likely go up again soon due to rising oil prices. What do we make of all this, and has this changed our fundamental outlook? As recently as April this year, the 10-year Treasury yield was 3.3%. This morning, we awoke to 4.3%, a full percentage point higher. Multiple factors have played a role. First, the real economy has remained stronger for longer than most expected. The economy grew at a moderate 2.4% annual rate in the second quarter, and the early projection from the Atlanta Fed's GDP Now model is that real GDP will be up at a stunning 5.8% annual rate in the third quarter. Real GDP growth is more likely to clock in at a 4% annual rate in Q3, but even that would be unusually strong. Except for the COVID reopening in 2020-21, there hasn't been a quarter at 4% plus since 2017. Meanwhile, inflation isn't going back to the Fed's 2% target anytime soon. Yes, inflation is down substantially from a year ago. The consumer price index was up 8.5% in the year ending July 2022, but a much smaller 3.2% in the year ending July 2023. But given the recent spike in oil prices, look for the year-ago comparison to grow to about 3.6% in August. The bottom line is that faster growth and persistent inflation are a recipe for the Fed to either move higher than the market expects or stay at a higher level longer than the market expects, or possibly both. Economists estimated the S&P 500 would finish 2023 at 3,900. As of today, that remains a solid forecast. In addition, I'm not ready to wave a white flag on a recession just yet. The conventional wisdom has lurched too far and way too fast against the odds of a recession. Many investors think that with an employment rate of 3.5%, the economy is somehow invulnerable to a recession. But this theory is wrong. Recessions almost always start when the jobless rate is at or near a low. Recessions are ultimately about mistakes, about too much optimism given underlying economic conditions, and the need for economic activity to adjust back downward. Consumers are soon going to be without the temporary extra purchasing power generated by COVID spending programs. Meanwhile, businesses are facing labor costs that continue to escalate faster than justified by productivity growth, while business investment looks poised for a correction. In addition, the government policies enacted in the last few years have not boosted long-term growth prospects. And although AI is a long-term positive, it is unlikely to generate enough extra growth in the short run to spare us a downturn. A monetary policy that is tight enough to eventually wrestle inflation down to 2% doesn't make for a pleasant economic ride in the next year. The road is smooth today, but potholes are ahead. As we conclude, remember, the information shared here is not a recommendation. If you're interested in discussing your personal financial situation, please don't hesitate to contact us at 920-686-7526. We're here to help, and guide you on your journey. This is Mike Halla from Michael E. Halla and Associates, signing off for now. Stay informed, stay prepared, and let's navigate the financial world together. Until next time.